Hello. In this video, I want to show you a really cheap or low-cost calendar spread. Let me show you when this trade was executed. Not too long ago, on June 25th at 5:33 p.m., I executed this trade with a 115 strike. Now let's see what happened on June 25th. We were right here on the 25th, like so. In this particular candlestick, which I am pointing out, I assumed that a breakout would occur. I chose a very cheap 115 strike, not because I thought the price would definitely reach that level, but for the potential rapid appreciation. So, I thought maybe we could reach this resistance level here. As you can see, the breakout didn't happen on the 25th. The market got crushed the next day, but it's starting to climb back up now. Essentially, what I bought at 0.20 in quadruple quantity is now quoting at 0.62. This is somewhat mispriced, I think, because the bid-ask spread is a bit wide, so it may be inflating the price slightly. If I check another platform, well, I doubt I could exit at 0.60. But the point is, the trade has more than doubled. It's currently quoting at 0.57, so if I wanted to, I could offload half at 0.57 and basically break even. Or I could even offload just one contract and significantly reduce my risk. Anyway, if I can close it at 0.60, that might be worth considering. The stock is starting to move upwards, and again, it's a question of whether we'll break through the resistance level. In situations like this, it's wise to set an alert on the position and keep monitoring it. My intention was to set up a super cheap calendar spread, and that's what I did. I thought we'd move up a bit sooner, but the market had other ideas. The point is, this position already has a decent profit. I could potentially close out a portion, but there's a chance for even more upside. This purple curve here makes me a little skeptical, because it's not common to see the purple curve diverge so much from the blue one. This typically happens when the bid-ask spread is wide, and it's showing the mid-price, which is not realistic for order execution. As I look at it on Tastyworks, if I were to close out a quarter of this position at 0.66, what would happen to the mid-price? The mid-price is currently showing, well, yes, that's the mid-price. Let's see if the order gets filled at 0.66. It's now at 0.62, but let's try at 0.65 out of curiosity, to see if I can offload one at triple the price. Nope, it doesn't fill. This is exactly what I wanted to show you. That's what happens in situations like this. Suddenly, it dropped to 0.15, which is interesting. The mid-price next to the 0.65 credit is now 0.35, and it has normalized. So, when you see an improbable spike like that, you can be certain it's probably due to mispricing because of the bid-ask spread. Now I'm looking at the bid and ask for the July 10th 115 strike, and the spread is indeed wide. Quick screenshot here. The bid is 0.33, the ask is 0.97. That's why it can show much more profit than there actually is. I tried to test it because you're almost certain not to get filled at that sudden high price. My order is in at 0.65, and the mid-credit is currently 0.38, 0.39. So I could even close half of it to make it risk-free. But for now, I'm not doing it because the SPX looks pretty bullish. There might be a breakout coming. Looking at the SPX, we have reached a certain level. There was a massive drop on Friday, but Monday and Tuesday are looking positive so far. This is the moment of truth to see what's going to happen next. There's also a gap there, but anyway, this video is not about the SPX. It's about this UPS position that I could almost take half off right now. But I'm not touching it for the moment. I'll even cancel the order. It's unlikely to get filled at 0.65 anyway, so it can stay. So that's the position, and that's where I'll pick up from next time. Back again, and we have an interesting situation with UPS's chart. FedEx's earnings report came out much better than expected, and based on that news, UPS was bought up pretty aggressively. I didn't anticipate this. It jumped from 111 to 118, so I quickly took the opportunity to close half of my position at 0.45, meaning there's no way to lose on it now. Here's the execution, just filled a minute ago. Now there's still plenty of time left in this trade, so I didn't want to close the whole position. Maybe there will be a small correction, and if we come back to this level around 115, and we trade sideways for a bit, digesting this large jump, then this can still generate a good amount of profit. This morning, the bid-ask spread was all over the place. I'll show you how volatile it was, although it's stabilized somewhat now. 0.45, currently at 52, the price has been fluctuating a lot. I've seen 34, 30, 36, 60, so the midpoint was somewhere around 45, 50, and I got filled at 45. At this point, there's clearly no way to lose, which was the primary goal, to lock this in to some extent. From here on, we'll see what kind of profit this can generate. I'm not going to fuss over it much now because the max it can go to is here, and then I didn't make anything, or maybe just $1.10. But I'll leave this half here and see what happens with it, as there's still time until July 10th, specifically 9 days left. So, the strategy has been modified, and I'll continue from here. Alright, it's 8:36 p.m. and I just wanted to share a quick update. UPS took a nice dip, and sentiments have calmed down, leading to the options I sold at 0.45 now trading at 0.66. So the price has essentially appreciated by nearly 50% as we approached and even broke below the 115 level. This was a pretty quick valuation change, and I wanted to point out how much can shift within a day, especially for the price of a calendar spread, if the stock takes a serious fall from, say, 119 to 114. There's still time left on this, and it would be nice if we were closer to expiration. I think you could squeeze out maybe a $200 profit from this position. However, if this enthusiasm doesn't hold and we drop back to 111, then it's advisable to consider exiting the position. Technically, it would be good to stay above this level. If we dip below, it's looking like a close. So, that's why I've managed the risk here to ensure there's no loss going forward. Just wanted to share this quick info, and we'll continue from here. Alright, back again. There's been a transformation in this position since the stock has been trading sideways for the last 3 candles. The longer it stays sideways, the higher the likelihood it's going to break out. So, just a bit ago at 6:20 p.m., I adjusted the position. I closed out a quarter of it at 0.80, so I'm scaling out nicely. I like that I can sell it at 0.80 compared to the initial 0.45, so I've scaled out and only a quarter of the position remains. Considering I got in at 0.20, this 0.80 selling price is very attractive. Had I been a bit more patient with risk management, I could have sold it for double by now. There would be a $253 profit, but of course it's not that much now, just $173. Realistically, it can't go up that much more. It can still go from 170 to maybe 210, but the range would have to narrow significantly for that, so I think 200 is its ceiling. I'm aiming to close it out accordingly. I've got 5 days left. Today is Monday, and it expires on Friday. Time decay is still working in my favor, and the delta is quite dull, so there's not much to worry about. Things could turn south if it drops to around 111 and breaks below that level, then it could start to lose. But if you look at it, the delta is really dull, like -1, so it's almost indifferent to what happens here. You could lose or gain plus or minus $10.20 if it moves significantly in either direction. But of course you've got to manage it and keep an eye on it. So only a quarter of the position is left, and I'll continue from here. Back again. I recently closed out this position, filled at 1.05 on UPS about half an hour ago. It's pretty awesome that I managed to buy it at 0.20 and sell it at 1.05. It was worth the wait. However, I decided to exit this trade mainly because it's so centered now, and there's hardly any more profit to be squeezed out. I didn't want to take further risks. As you can see, it's been trading sideways for about 5 days, so something is bound to happen sooner or later. And I definitely didn't want to stick around with this calendar spread one day before expiration. It's Thursday today, and it's going to expire nicely tomorrow. So I got out at 1.05. Using scale-outs, I had a 45, an 80, and a 105, making the final profit $195 based on the initial $80 investment. There's a significant cost to scaling out. If I hadn't exited any of the positions, there'd be a floating profit of $358 on it right now. But as we know, risk management comes at a price. If the whole thing had collapsed, it would have been a total loss. So, it's an individual choice how you manage risk and when you try to extract profit. I try to do it as quickly as possible, which often reduces the potential profit, of course. I could have sold each of them for about $1 now, instead of at 0.45 and 0.80. So, to sum it up, there were basically two adjustments, and it closed with about a 200% profit. It required a sizable gap up, but afterward, the underlying didn't move at all. Closed it out with a $195 profit. Hope there were some useful insights here. If you have any questions, feel free to reach out. Thanks for your attention. Bye.